right, let's take a look at the major indexes. Joining me now is Chance Finucane, Chief Investment Officer for investment advisory firm Oxbow Advisors. Chance, thanks so much for coming on the show. Mixed market today after ending at session lows yesterday. What does this mean for investors?
We still think investors are trying to process Fed Chairman Powell's comments in the last couple of days. We don't think they're quite have reached the point that we believe they should, where especially short-term Treasury rates are going to stay higher for longer. And that leaves more room and more time for things to slow down and go wrong in the economy and in the financial markets. And if that's the case, we actually think a better entry point for equity investors is going to be at a lower price than where we're still seeing today with the S&P 500 hanging around $4,000.
So what's going to be the impetus, Chance? I mean, I agree with you. I think the equity market has proven pretty resilient and maybe a bit more optimistic than data-based, certainly this year on the back of those big gains that we saw in January. What is going to be the impetus to move stocks lower as you're forecasting?
We would say it's probably going to be company profits. You've seen estimates for profits for companies individually and the S&P 500 in aggregate have been coming down since last year, and we would expect that to continue as long as you still have an environment where inflation is going to stay a bit higher than people expect. Wage growth is hanging out at around 5% a year compared to last year. That's going to be difficult for a lot of companies to try to keep growing revenue faster than their expenses. And if profit margins continue to compress and revenue growth is starting to slow, we would expect that to be a reason to drive earnings lower. Secondly, you could also start to see more events happen in the credit markets, especially as you see more companies need to refinance some of their debt. And if they don't have much cash flow of their own to base it off of, maybe they have a difficult time refinancing, and that leads to wider credit spreads over the course of the year.
Is there any safe place, Chance, in investors' 401ks, their IRAs, perhaps even their brokerage accounts to put money to work right now?
There is. It used to be you had to try and just pick out anything in the stock market that might hold up, but you've got short-term treasuries yielding 5%. You also have a lot of other investment-grade securities like preferred stocks, some real estate such as REITs, and some MLPs, all yielding between 6 and 7%. Those are okay places to be right now while you wait this out for a better entry point. And then within the actual equity market, we've seen some defensive sectors pull back, such as healthcare and gold stocks, and consumer staples are starting to pull back a little bit as well. Those are all going to be areas that you could start to allocate a little bit more capital in the meantime while you wait for some of these more cyclical areas to pull back further.
How should Americans, Chance, be budgeting for inflation? They might be wondering, should I put money to work in the stock market, or do I need to keep some cash on hand because inflation might persist for much longer than expected?
We actually think we're less worried about that now. We could see that question last year when inflation was 7 to 9%, but we think by the middle of this year, inflation will fall to about 4%, and then it'll stay at around that level, which is going to be a problem for the Federal Reserve because that means they're going to have to keep interest rates higher for longer than investors would like. But if inflation can just settle at about 4% and you have short-term treasuries yielding 5%, you can keep some money invested in short-term treasuries and basically maintain your purchasing power while you wait for a better entry point. And then if you get another 10, 20% drop in the S&P 500 and stocks in general, then you can start to allocate more to riskier assets where you think the expected return is going to be higher over the next handful of years.
Okay, good to know. We're going to have a jobs report on Friday. Chance, any expectation as to whether or not that momentum, that blockbuster report and job gains that we saw in January might continue into February?
Well, in recent months, it seems like the projections have always been understating what the actual number comes in at. And we don't try to use the jobs number as a predictor for economic growth since it's a very lagging indicator. It's usually the last thing that changes direction. And by the time the unemployment rate starts going up, you would be leading into a recession. So it could come in stronger than expected once again, like it has in recent months, but it wouldn't really change our opinion about continuing to maintain a cautious and defensive stance with our clients' portfolios.
All right, Chance Finucane, Chief Investment Officer at Oxbow Advisors. Chance, thank you on a mixed day for stocks.
If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.